We hope you find this information useful, and if you have any questions regarding the content of this presentation, please do not hesitate to inquire with your relationship manager or by sending us an email. Please be aware that this presentation does not constitute any form of investment advice and is only reflective of information that is available to the presenter at the time the presentation is being made. The material presented is just for information use only. Please speak to your advisor prior to making any investment decisions.
Hello everyone. The purpose of this presentation is to provide our clients additional information and answer specific questions on the launch of our newest mutual fund. The fund's name is the Yorkville Crypto, Blockchain, and Fintech Fund. This is a mutual fund, but is available in institutional and private client series, but also in series that are usually sold by mutual fund and IROC advisors. The fund prospectus, marketing material, and updates will be available on our webpage shortly. This fund was specifically designed to provide our clients access to cryptocurrencies and blockchain technologies. We believe we can do that with lower volatility due to our diversification strategy while providing cheaper and more secure access than directly owning cryptocurrencies or managing crypto digital wallets. The biggest advantage of our fund, like I said before, is its diversification across the entire digital assets and cryptocurrencies. We will own digital assets like Bitcoins, Ethereum, and others, but also own shares in publicly traded digital exchanges, blockchain technologies, and many companies that are essential to the functioning of the entire fintech ecosystem. Starting from the top down, we believe that the acceleration in fintech disruptions are here to continue. While all of us have heard of Bitcoins and other digital assets, they are only available to us as an alternative asset classes due to the advancement in blockchain or distributed ledger technologies. The size of the disruption is material. We have seen it in lending, for example, that is now available through virtual banks, or in portfolio management through robo-advisory, and even in the sale of simplified insurance online. The crypto evolution or revolution is one of these advances that is most dominant yet so far. It is certainly getting a lot of news coverage as both institutional and mid-market clients and investors can participate with the risk-reward formula. This chart shows the size of the market and the annual investments that are funding new fintech startups on an annual basis. Starting with the basic concept that allowed the creation of cryptocurrencies is what is called blockchain or distributed ledgers. Many of us studied accounting and remember the general ledger concept. This is no different, except unlike the general ledger, it never restarts at the beginning of a new fiscal year, and that all the transaction history or missing parts are recorded. But unlike the general ledger, it's called distributed ledger because this information is stored in bits and pieces across many computers that are connected on a network. The smaller, fragmented, and well-distributed structure of this data makes it impossible to hack, for example. There is no one location that hackers need to break into to get access to your data. There are thousands, if not millions, of computers around the world. This provides me and you security, but naturally creates challenges to governments that like the concept of centralization and control. Today, there are two types of blockchains. Permissioned ledgers. These are the ones that are only available by invitations only. This is the system being used by the People's Bank of China and the Bank of England in managing their cryptocurrencies. But the more popular type is called public or decentralized ledgers. Anyone can join and no one has the final say. There are two frameworks that are currently the most dominant for validating transactions. And those frameworks gave the birth of the actual digital currencies, Bitcoin and Ethereum, the two largest digital currencies trading today. The difference between the two technologies is the way they validate transactions. For Bitcoin, for example, there's a reliance on what is called proof of work to validate a transaction, while Ethereum uses proof of stake concept. They are both valid, but for the time being, the growing popularity of Bitcoin seems to be the dominant trend. When asked about Bitcoins, trying to explaining it to clients, I always advise them to think of a Bitcoin as a bank that issues its own digital coin happens to be called Bitcoin also. I know it is confusing, but this distinction is important when we talk about Bitcoin wallets, for example, for paying transactions, or Bitcoin as an investment in your portfolio. No different than the newly issued coins by JP Morgan. It's called the JPM coin, or the coin that's issued by Facebook. If you think of Bitcoin as a bank, this bank is already 2 times the size of JP Morgan, or 3 times the size of Bank of America. Also think of this Bitcoin bank as having one of the largest market caps among publicly traded companies. It certainly ranks ninth, roughly, as the value changes, but roughly ninth after gold, Apple, Microsoft, Google, Tesla, and others. Of course, the market capitalization calculation is constantly changing, but with the attention digital assets are getting, we suspect that they will be among the largest companies in the world. We are often asked, why did we decide to launch this fund? Many investors have missed the investment opportunities that occurred in the fintech sector. The 4 trends that have occurred so fast and have proven to be successful are microfinancing and crowdfunding, payments and remittances, robo-advising, and last but not least, cryptocurrencies. The investments in this sector continue to grow, and as the chart on the right-hand side demonstrates, and has reached 140 billion per annum, and we expect this trend to accelerate in the next few years. This is the piece of the pie that we want to participate in. We want to participate in the rewards from these disruptions and bring positive change to our financial industry. Blockchain technologies that have used to create cryptocurrencies are not new and are used by banks like JP Morgan's Quorum system or the JP Morgan coin, Microsoft Azure, or Amazon Web Services, or ENY and their smart contract system called Nightfall. But technologies like GE, Starbucks, 3M, and others are using these distributed ledger technologies not just for payments or for digital currencies, but also for tracking all their supply chain and manage costs across the 100 or so markets that they operate in. It is actually quite interesting to learn how Starbucks, for example, uses blockchain technologies and Bitcoin technologies for tracking supplies and shipments. If you're interested, you can find this information online on Microsoft Azure webpage. The history of digital asset goes back to 1989 with DigiCash. The system failed because it had a centralized system. The Bitcoin idea, or the idea of a digital coin and a decentralized bank, was launched in 2008, and the first Bitcoin to exchange hands occurred in 2009. In 2010, the first crypto stock exchange was launched, and in 2011, the value of Bitcoin reached $1. It was not a smooth ride though. I'm sure you all heard the story when Bitcoin was worth a few cents, and an early investor, Laszlo, used 10,000 Bitcoins to pay for Papa John's pizzas. That was in 2010. Today, these Bitcoins would have been worth more than 600 million. In 2014, Microsoft accepted Bitcoin protocol and payments in Bitcoin. And in 2017, Bitcoin surpassed $10,000, and as of today, it's hovering around $40,000. The key concepts that gave birth to Bitcoin are still valid today. Cutting the middleman, decentralization, open to any participant, privacy and security remain the cornerstones in the success of the Bitcoin and blockchain story. The challenge is in the consumption of energy and the processing power to track, validate, and maintain all of the historical records. The ability of everyone to own a crypto wallet, and of course the abuse by money launderers and the possibly tougher government regulations from this point on. All these challenges will present headwinds, but not obstacles to this disruptive technology in digital assets. Here I want to draw a distinction between Bitcoin as a bank and Bitcoin as a currency. In our view, crypto as a currency for paying for transactions has its limitations due to the significant price volatility. You cannot use Bitcoin and any other digital asset to pay for something because you do not want to have the same surprise Laszlo had in 2010. You might think you have bought a car for 120,000 in Bitcoins to find out 2 years later that the car actual cost was 20 million. Additionally, wallet keys and access and security of all these personal wallets add a layer of threats that most individuals do not want to deal with. However, thinking of Bitcoin or Ethereum as a bank or as an investment or an asset class makes perfect sense. Trading Bitcoin resembles trading in currencies or any other investments. It is an asset class that has an average daily return, has best daily return, worst daily return, and so forth. The numbers that I'm presenting might be stale by now due to the significant changes that occur on a daily basis in the prices of Bitcoin or Ethereum. Nevertheless, they still demonstrate my point. Likewise, I've kept talking about Bitcoins, even though our fund will invest in different digital assets and technologies. But the price of Bitcoin relative to all digital assets is almost similar to the relationship between the S&P 500 index and the stock market. So when I'm referencing Bitcoin or Ethereum, I'm referencing the entire digital asset class. Bitcoin is also the largest digital currency that's traded among its peers. It represents roughly 50% of digital asset market and has futures that trade and settle on the Chicago Mercantile Exchange, the CME, and has ETFs and mutual funds that track its price. So therefore, it is the most transparent of the entire digital asset investable universe. This slide further demonstrates the point that I was making earlier about the dominance of Bitcoin in terms of market capitalization and the average daily trading. As our fund is a liquid mutual fund, and we will be looking at these liquidity factors when deciding on our allocation, as liquidity tests are key regulatory concerns. We heard about the good news relating to crypto assets, but there is no reward without risks. And the risks in this asset class are quite substantial. The peak to bottom on major shifts, we saw drawdowns in the magnitude of 60% or even as high as 85%. This means an investor that invested and sold at the wrong time potentially lost most of his investments. This is why we want our clients to approach this investment as an asset class. This means you must have a long-term investment horizon and allocate a certain percentage that's suitable for you and your risk profile from your entire portfolio. Do not allocate more than what you can afford to lose. You can use ETFs or funds like ours to provide you with some diversification and lower your overall risk when compared to owning just a digital coin in your wallet or a digital ETF. This is a higher level of protection. We participate in the performance of the asset class, but lower the volatility in down cycles. Of course, you should always talk about the investment with your advisor and understand the risks and the rewards, but also fees, commissions, and other variables. Our fund is new and we do not have performance history and we cannot show it. But this chart shows the growth in Bitcoin prices since August 2016. The price is almost up 82 times, representing close to 140% of annual returns. The chart also shows the spikes and the corrections. So only invest if it matches your risk profile, or alternatively allocate a certain percentage of your portfolio and buy into the fund regularly so you can accumulate or average the cost of your acquisition.
Crypto is not going away. That's not going to happen. We are so early into crypto. I think the potential of this sector is trillions of dollars.
The Bitcoin credit card will be the next thing, but these are more commonly used when crypto assets that have a fixed price to a US dollar or other currencies. This is the case with Facebook coin that is pegged to a basket of currencies, or the cryptocurrencies issued by the Bank of England and the People Banks of China. So who is this fund designed for? It's designed for investors with above average risk level and have a long-term investment horizon. Second, investors that want exposure to digital assets but do not want the headaches or concerns of owning a digital wallet. Third, those who want to participate in the upside potential of digital assets and blockchain technologies but at a lower volatility. And fourth, for those who are interested in fintech disruptors like Square and others. If you are concerned about inflation and the deterioration in the US dollar or Canadian dollar purchasing power, with all the deficits and money printing that is taking place, this fund is an appropriate place for you to invest in. Last but not least, if you have a balanced portfolio or equity risk profile, and an allocation of 2 to 15% might be suitable. You should do not risk more than what you can afford to lose, and you should do your risk assessment and speak to your financial advisor in order to determine what's the appropriate allocation for your portfolio. This is a new fund that has a higher risk profile than the traditional Yorkville funds. There are no options to hedge and to protect on the downside, a feature that is common in most of our other funds. Its top holdings are Bitcoin, Ethereum, Coinbase, Hive, and Global E, and they're all in the payments and digital currency space. As for the portfolio management team, to complement the new crypto fund existing team, Yorkville realized that it's important to add specialized expertise to support the existing PM team. This year we added Derek Brenzel and Luke McIlhargy, who are both CFAs and bring more than 20 years of investment experience. Luke also holds the CAIA charter in alternative assets, which deals directly with non-conventional asset classes such as blockchain technologies and cryptocurrencies. Many of you will meet Luke over the next few months. If you are interested in investing in this funds, please speak to Haley or Liza in Alberta or Luke. We will be sending additional information like prospectus and other marketing material to our partners via email and direct mail. We look forward to hearing from you, and we are excited about what this opportunity brings to us, to you, and your clients. Have a good day.